Good afternoon, everyone, and welcome to the Equifax Q2 2022 Market Pulse update, where we're going to be talking you through some of the key trends in the consumer credit market. For those of you who haven't met me before, my name is Becky Oakes. I'm the Vice President of Analytics here at Equifax, and I'm delighted to be joined today by our Vice President of Consulting, Kathy Katsouleras, and our Head of Analytical Insights, Swarnima Pandey. So before we get started, I'd like to hand over to Sandra, who's going to talk you through how to navigate the On24 platform.
Thank you, Becky, and good afternoon, everyone. Each area within the On24 platform is responsive, so you can maximize or minimize each widget or box on your screen based on your viewing needs. There's an Ask a Question widget underneath the slide area, so feel free to enter any questions you may have, and we'll address them throughout the session today. In case there's too many questions to get through, we'll generate an FAQ document, which we'll send out to you in the coming weeks. Some related content is available for download, and today's presentation in English and French will be available in the coming days. Our session is being recorded, and you will receive the on-demand link via email tomorrow. Some additional features you'll notice on the bottom of your screen are an attendee chat, reactions, register now for our upcoming Small Business Trends webinar on September 15th, our survey, which will pop up at the end of the webinar, and contact us. Feel free to check any of these out and provide your feedback. Always welcome. Now let's get started. Becky, back to you.
Fantastic. Thank you, Sandra. So as always, we're going to start off by taking a little look at what's happening with the economy, and specifically at some of those key elements that could lead to changes in the credit industry. So let's start off with inflation. Now, this has been a hot topic for a few quarters now, and unfortunately, it's not really going away anytime soon. Now, inflation is most commonly caused by a few things. So some imbalance in the supply and demand of goods. So if there are more people wanting to purchase a particular good than exists, then prices tend to go up. It can also be triggered by money policies, supply policies, or it could even be some sort of shock in terms of consumer behaviors. So the COVID period created a bit of a perfect storm on several of these. So we had supply chain issues leading to reduction of the availability of certain goods. And we also had those periods of lockdown, which led to some of that pent-up demand by consumers. Now, combined with that, there also were those government support mechanisms and in the credit industry, some of the lender side as well. And that really led to releasing of more money into the economy. So some of the consumers actually had more money in their wallets than perhaps they had prior to the pandemic actually occurring. Now, when you combine all of that with the global instability we have right now, so particularly in Europe, and some of the impact that's having on commodities, it's really not a huge surprise that we really have this inflation challenge going on. Compared to the same time last year, the most recent numbers are a 7.9% rise in inflation, and compared to pre-COVID levels, when we look back to 2019, it's around a 12% rise. Now, the main challenge for a lot of consumers and businesses is that this inflation isn't limited to just one of those essential elements. It's across multiple of the core things like food, energy, transportation. And so really this is contributing quite a lot to the cost of living that people are experiencing here in Canada right now. So there is some good news, and that's really that our labour market is still strong. Unemployment levels are really below where they were pre-pandemic, and in fact, we're actually at a historic low currently. And you can see this on the left-hand chart, where that red line is the unemployment rate and the grey line is employment numbers. The less good news is that we do have an increasing volume of vacancies, and in certain sectors, that's actually having a really large impact because those labour shortages are limiting the ability for some companies to operate as they should be. So if we're not careful, that can actually start to impact other economic measures that we tend to look at as well. Now, interest rates are a key way to help curb rising inflation. The idea being is that it drives higher borrowing, it kind of encourages people to spend less. And this ultimately leads to a drop in that demand side of things. So the supply and demand becomes a little bit more in balance. The Bank of Canada has been taking quite aggressive action. I'm sure we've all seen it in the news. And we are going to be talking quite a lot today around what that could mean in terms of some of the impact that could be having right now, potential impacts it can lead to in terms of the credit industry. But just to bring this to life a little bit, the left-hand chart shows some of the key interest rate rise periods since the late 90s. So, for example, if you look at that first bar back in 1999, we saw a 125 bip increase over a 7-month period. And one of the largest increases was actually in 2004, where there was a 225 bip rise over 21 months. Now, if we fast forward to where we are currently and look at that last column, you can see the 2022 numbers. So we've had this huge 300 bip increase in just 6 months. And this really does create a bit of a challenge, because when we try and forecast the impacts of this, there isn't really a good historic period we can use as a basis, because it's far more aggressive in terms of rise than what we've seen previously. So we can still look at those other periods, but it's not as comparable as perhaps we would like it to be. And it's also quite a different start point when you look at the current state of the marketplace and how consumers are. Consumers tend to be in a much better position than perhaps we saw previously. During COVID, we saw those debt levels start to fall as consumers were making more payments than ever before. We saw incomes did start to rise, and we saw savings increased. So overall, consumers are better prepared to some degree to manage a rise in things like interest rates. So that might offset it a little bit in the short term. But again, the increase we're seeing is really quite significant to what we've ever seen before. Now, just looking back through time, and if we do look at the most recent comparison we have, that was in 2017 and 2018. And that's where we had a 125 bip rise in a period of 15 months. So some of the key things we saw back then, we saw a rise in insolvency rates once that increase hit 125 bips. We saw non-mortgage delinquency start to rise. And in particular, we saw some of the biggest impact was where consumers had those variable rate products, so things like home equity lines of credit. And on those consumers, the deterioration was far quicker and greater than perhaps the whole population as a whole. So that's kind of what's going on economically high level in Canada. But what about what we see in the rest of the world? Now, maybe unsurprisingly, the pressure of rising inflation and the need to increase interest rates to kind of curb that is happening in other countries as well. So impact-wise, in Australia, we're seeing demand for personal loans and buy now, pay later deals. That's been on the rise as consumers have started to leverage credits more and more. We're seeing similar behaviors across the border in the US, with personal loan debt increasing by around 23% in the last 12 months. And in particular in the US, we're seeing a lot of that growth in the subprime part of the population. And if we go over to the UK, we're actually seeing some really great insights when we look at their current account transaction data. They're seeing consumers heavily pulling money out of their savings and using that for their spending, perhaps to kind of cover themselves in the short term. I'm sure you've heard over in the UK, the energy prices really are quite significant right now. And also in the UK, we're seeing quite a lot of reliance coming through on high-cost short-term credit. So that's kind of what's happening very high level globally, some similar sort of trends to what we're going to be talking about today. But if we switch over to kind of what's happening in Canada, we can look at some of the key themes that we're seeing in this quarter. And there's really 3 talking points that we're going to be digging deeper into in today's session. So we are seeing increased demand for certain credit products, and in particular on credit cards, where applications and approvals for new cards are back up again after a real low period during COVID. We're seeing credit card spend has risen significantly, and we're seeing the overall balance on credit cards reaching back to pretty much pre-pandemic levels. So all of that benefit we saw during 2020 and 2021 with lower balances, it's really reversed now, and those credit card balances are back up again. On the housing market side, there are signs of cooling, and we really expect that to extend into Q3. This data right now is to the end of June, and obviously some of the slowdown we're seeing in key markets like Toronto, that's really been coming through more and more in July and August. But the important thing we're seeing is that back in June, although there were some reductions in those prices and some of the mortgage levels, they weren't really helping the affordability side yet. So we're going to dig a little bit deeper into some of the consumers that might really be impacted by that. And then finally, when we look at some of the key indicators of financial stress, we're starting to see some deterioration in both the numbers of consumers who are missing payments, as well as rises in areas like insolvency, so some of those key indicators of severe financial difficulty. And we are going to be detailing a bit more on that in terms of what to watch out for on some of the key metrics, because when you have a fast balanced growth period, as we're seeing right now, there are certain measures that can get masked for a period of time. So we're going to, I guess, dig a bit more into that so you can understand that's how it might appear in your portfolios as well. Okay, so when we look at the period to the end of June, overall consumer debt increased by more than 8% to around $2.32 trillion. Now, some of that, of course, is the mortgage debt side, which even with some of that cooling coming through in the market, it's still seen a 9.2% increase over the last 12 months. But it's really the non-mortgage debt side where we're going to spend most of today looking at those balances as they have risen around 5.2% compared to the same period last year. Now, at a consumer level, average non-mortgage debt rose both year on year and quarter on quarter, and that's sitting at a little bit over $21,000 right now. And if you look on that left-hand side of the chart, you can see the comparison to 2019, showing that we are starting to see that average consumer debt get back closer to pre-pandemic levels. And just as a comparison, if we compare Q2 of this year to Q1, average debt has increased by around $400 per person, so quite a significant shift in just one quarter. Product-wise, on the right-hand side, you'll see almost all of the non-mortgage balance products have seen some sort of rise, but credit card is really the standout one where we've seen the biggest movement. So we've seen a huge 14% rise compared to balances at the same period last year. Lines of credit are also showing a fairly substantial increase at 6.8%. And then when we look at the auto loan side of things, that's really the only product where we've seen a decline. And Swanamo is going to talk to you a bit later on about why that is. But that's still heavily linked to some of those continuing supply chain challenges in that particular industry. Okay, so what about how consumers are performing on their credit commitments? Well, in terms of financial stress measures, one of the key things that we look at is severe delinquency. So this is where a consumer has missed a payment on a trade for 90 days or more. And there are two ways you can look at this. So you can look at the percentage of total debt balance, so the dollar amount in the market where payments are being missed, or you can also look at it at the percentage of accounts where payments are being missed. Now, typically, these two measures often show very similar trends. But what you can get in a fast-changing environment is they can sometimes suddenly show opposite trends. And this is what we're seeing in Q2. So I just want to spend a few minutes talking you through about why we see this. So when we look at the percentage of total balance where payments are missed, we're still seeing a decline year on year and quarter on quarter as a kind of percentage rate. And you can see that when you look at the left-hand side box, that 90-plus day dollar delinquency amount is at around 0.88%, and that's still below that pre-pandemic level of 1.2%. Now, if we actually look at the percentage of trades or accounts where payments are missed, we actually see a 6.5% rise compared to last year and around 4% compared to last quarter. So you might be wondering, well, why do we see balances going down and kind of the account percentages going up? And there's a couple of reasons. Firstly, the non-mortgage debt balances, they've been rising very quickly over the last 2 quarters. And that's actually the bottom number in the calculation. It's kind of the total balance on delinquents versus total balance divided by total balance. So if that bigger number is increasing faster than the top number, actually the rate comes down. And that is what we're seeing right now. So in addition to that, what we're also seeing is that average balances on delinquent accounts are much lower than they were 12 months ago. And that's really having a compounding effect on top of that kind of balance growth that we're seeing. Now, on the flip side, the volume of trades with missed payments is actually on the rise. And if we actually look at that in terms of where we saw 12 months ago, it's definitely increasing as well. So it's quite hard to get your head around what that tells us. But I guess to summarize, when we look at delinquency, the good news is that balances on severe delinquent accounts are lower than before. But the bad news is that more consumers are starting to miss payments. And we're not really seeing any reason as to why we expect those number of consumers missing payments to reduce anytime soon. So in fact, we're actually seeing a bit more on the early delinquency side of things rising as well. So if we try and look at this in terms of at a product level, that chart in the middle kind of shows that delinquency across a few measures. So the gray line is the balance delinquency for one or more missed payments. And you can see that even with that kind of growth in non-mortgage debt, early delinquency is actually up year on year, even on the balance side of things, so that gray bar. The blue line is that balance delinquency of severe delinquency, so 90 days plus or more, and that's still lower year on year. but the red line shows that volume view, and that's where we're seeing those kind of large rises in particular. In terms of where that's really coming through, we're seeing that on credit cards and auto loans first, and that's quite normal in terms of when you start to see financial stress coming through. Those products do tend to be the first ones where we see missed payments. Now, if we think about this at a consumer level, the difference between this time this year and this time last year is we have over 100,000 more consumers missing a payment in that quarter. So it's quite a significant number and volume of people that actually are missing payments right now. So finally, when we're looking at some of those more severe financial stress measures, we tend to look at insolvency as well. And the good news is, again, we are still below those pre-pandemic rates with overall consumer insolvency at 0.08%. But when we look compared to 2019, pre-pandemic, it's 0.13. So we are still below that pre-COVID level. The less good news, though, is that these levels are rising, and we've seen a 5.6% rise compared to last year and a 6.8% rise compared to Q1. Now, where we're seeing this is really on the use of consumer proposals, and this has been growing in terms of popularity as it really has that benefit of protecting certain assets, unlike a full bankruptcy where if you have your own home, some of the equity in there isn't protected, and obviously you may have to sell your property along with the bankruptcy. From a region standpoint, we are seeing this across most regions. Ontario is showing the biggest shift year on year, but again, it's really coming from some of the low points last year. Okay, so that's what's going on at a high level overall, but I'm going to pass over to Swanema to talk you through some of the detail really on what we're seeing across products in particular. So Swanema.
Thanks, Becky. Let's go deeper into each of the product categories. So first up is credit cards, and we have seen a strong growth in credit cards. They have been one of the primary drivers of non-mortgage debt this quarter, with overall credit card balances are reaching close to pre-pandemic levels after more than a year. Now, multiple factors affected credit card balance growth. Firstly, the increasing number of new originations in credit cards that are being added to the overall portfolio balances. This increase in new card uptake is seen across all provinces. We have seen one of the biggest increase in credit card new card volume in BC, surpassing 2019 levels, and Ontario almost back to pre-pandemic levels. While we saw a big increase in new card volume, we are seeing a much bigger increase in average credit limit on new cards. It's increasing at a much higher pace, as you can see from the chart on the left side. There's been a significant increase in credit limit given to new accounts, and the average credit limit as of this quarter has reached $5,800. This is the highest credit limit that we have seen since 2015. It's up 23% from pre-pandemic period. The table on the right shows the average credit limit is higher across all provinces, with Ontario and BC, the levels have exceeded $6,000, and it's up more than 20% since 2019. Now, another contributor to the increasing credit card balance is consumer spending. We are seeing consumer spending on credit card has reached historically high levels. The green line on the left-hand side chart shows the average credit card spending has been strong in 2022 with a recent surge beyond seasonal trends. Now, inflation, return to shopping and traveling has driven credit card spending up by 22% from 2021 and almost 20% higher from the pre-pandemic period. And consumer day-to-day spending is being impacted with high inflation rates, and growing inflation is slowly raising the prices of day-to-day goods and increasing the cost of living. Now, average consumers have spent more than $300 this quarter when compared to the same time period in 2019. And this sharp increase was evident nationwide, with BC and Quebec leading the way. Also, consumers in the age group 35 to 54 have seen over $500 increase in their credit card spending if I compare it to 2019. So we took a closer look at the credit card spending, and it shows a major shift in low average monthly credit card spend. So the chart shows the distribution of consumers across average monthly credit card spend per consumer. So from the second quarter of 2019 to the second quarter of 2022. And as you can see, there has been a big drop in the number of consumers spending less than $1,000 on their credit cards. And higher day-to-day expenses have pushed these consumers to the higher spend bucket. And maximum impact can be seen again in the age group 35 to 54, where the proportion of consumers are spending more than $6,000. And there's an increase in the proportion from 34% to 42%. Higher spending has also led to lower payments in the later half of Q2. And we are seeing revolving behavior and credit card delinquencies rise from the lows of 2021. And since early we can see that the credit card revolving rate is especially higher for Alberta and some of the other Western provinces. When we look at 90-plus delinquency rates, we are also seeing an early increase among consumers under 35 years of age. And we anticipate a steady rise in credit card delinquency till the end of the year. Switching gears to auto, supply chain issues are still impacting auto industries, and it's visible in auto new originations. The new originations for auto loans have remained lower than the pre-pandemic levels. We only see an increase in auto loans, but demand for leases is consistently going down. With lower new car availability and higher wait time for luxury cars, leasing has taken a back seat. Normally, leasing is a very attractive option for consumers who want new cars and want to pay lower on their cars. But rising car prices are just negating the payment advantage that leasing traditionally has over loans, and making this a lesser desirable option at this point in time. And we can see that leasing has dropped across all provinces. It's only in the new auto loans that we see a lot of regional variations, which could directly be correlated with vehicle availability in these regions. The biggest year-over-year increase is seen in Ontario, while all the other provinces are not seeing the same growth in new originations. High demand and lower supply has pushed car prices up. As you can see from the charts, that the average loan amount for new cars is increasing year over year. It is a very common trend that we are seeing globally across the US, UK, and Australia. An average loan amount for new auto loans has seen the biggest jump in Ontario, BC, and Quebec when compared to the pre-pandemic period. Another segment that has been hugely impacted by supply chain issue is the used car segment. We have talked in length about used cars in our past webinars, and we have seen exceptionally high demand for used cars, and this has pushed the used car prices to never before seen level. In fact, average loan amount for used cars went up by 23% when compared to the already high Q2 2021 level. Now, these higher loan amounts are resulting in higher amortization terms for used cars, so consumers are paying way more for used cars than they would pay before the pandemic, which could be a long-term concern. Now, just like credit cards, we are also starting to see 90-plus delinquency rates for auto loans rise. While balance delinquencies for auto are slowly rising, but if you look at the 30-plus account delinquency levels, so the early account delinquencies, we are seeing a much bigger jump in delinquency from the last quarter. And again, the consumer group most impacted by this is the higher spending consumer group, which is the 35 to 44 consumer segments who hold over 45% of all consumer debt. And they're showing the maximum rise in auto delinquency levels, although the levels are still way below pre-pandemic. Usually, both credit card and auto payments are leading indicators of rising financial stress. And we are starting to see that more consumers are missing payments on either or both of these products. Moving on to mortgages. So mortgage market in Canada has been very unpredictable. All the predictions that people had during the pandemic that a mortgage deferral cliff is going to hit and people are going to go delinquent and the mortgage market will crash, it has all been dismissed now. Pandemic drove overnight interest rates to rock bottom, which led to a dramatic increase in new mortgages in late 2020 and early 2021. And we saw a much bigger jump in first-time home buyers. But now we are seeing a slowdown in the hot housing market with 300 bips increase in interest rate over the last 7 months. Now, higher mortgage demand coupled with lower interest rates skyrocketed home prices, driving the average loan amount up. If we look at the distribution of new mortgages in the right chart, we see that the average loan amount for new mortgages has shifted. More consumers now have a greater than $600,000 mortgage than consumers in 2019, so almost doubled, and putting more financial stress on, especially on first-time home buyers. Let's dig deeper to understand what's happening with first-time home buyers. Despite the high home prices, first-time home buyers could afford high mortgages during the peak pandemic period because the interest rates were really low, and that helped them reduce their monthly payments. As you can see in the chart on the left side, both in late 2020 and early 2021, first-time home buyers took higher loans when compared to 2019, but their monthly payment did not increase much despite the higher loan. But as we move closer to 2022, we see that shift, that first-time home buyers are losing the advantage of lower interest rates amidst rising house prices. Now, high interest rates have brought some price correction in the housing market, but it has not yet had a huge impact on average loan amounts of new mortgages, especially for first-time home buyers. The average loan amount for first-time home buyers in Toronto and Vancouver has exceeded $600,000 this quarter, which is still a 3.9% quarter, still a closer to 4% quarter-over-quarter jump in average loan amount. So first-time home buyers are more leveraged, have higher loans, and are paying much higher monthly payments. But the true impact of the rising interest rates on house prices will likely be seen by the end of the year. While we saw that credit card and auto delinquencies are slowly rising, we don't see the same increase in mortgage delinquencies, as mortgages are usually the last product that people go delinquent on. And pandemic has reversed the trends in mortgage delinquencies, and we are yet to see any increases in mortgage delinquencies. So though the levels are lower for mortgage delinquencies, the average mortgage debt per consumer is much higher as of 2022 than it was in 2019. So consumers are heavily leveraged, especially those with a variable rate mortgage, now that the interest rates are up and has even exceeded the 2021 stress test level rates. It can increase the financial stress for many consumers. So again, the rise in mortgage delinquency we'll see in the much later half, and first we'll see the delinquencies rise in the non-mortgage segment. Now I'll pause for some questions before moving to the next section.
Fantastic. Thank you so much, Swarnima, for going through that detail. So we do have some questions coming in. First question was around, are rising interest rates a big concern for people with variable rate mortgages? I don't know, Swarnima, if you want to take that or...
Sure. Rising interest rates definitely could put more pressure on consumers with a variable rate mortgages or any variable rate products like HELOC. And I know we are going to cover this in the later section. Kathy will be covering how consumers will be impacted. But if we see consumers who took out a loan in 2021 with a variable rate mortgage, the interest rates have increased the stress level that they qualified at. So we might see more financial stress for those consumers who took a variable rate at a lower rate, and now the rates have increased.
Yeah, I mean, I think the only thing I'd add to that is the slightly good news is obviously recently originated mortgages have been through a stress test. So even though those interest rates may be impacting them, in theory, they've already been assessed, at least, for the recent cases, to a level where that consumers should still be able to make those payments, even though obviously the actual rate may go up. Also, for a lot of consumers on the mortgage side, it's not necessarily the monthly payment that goes up. Sometimes the term extends out. So, there definitely is some potential risk there, but I think there is also kind of a bit of a mitigation against that, at least in the short term. I think when you look forward to the future and you look at interest rates, if they maintain at a higher level for, the next 12, 18 months, consumers on fixed rates and things may have to start renewing their mortgages. And depending on what they originally had their mortgage rate at, that obviously could lead to some stress coming through. So great question there. There was a question which was, can the missing payments from non-mortgage products be caused by the payment on mortgage loans? So, for example, the borrower is preferring to pay off their mortgage debt first than other forms of debt. I guess my simple answer to that would be yes. That is absolutely a potential situation that we could be seeing. It's very difficult to pull apart whether that is the case. I guess we could look at those delinquencies and have a look and see do they have a mortgage or not. But obviously, it could just be that they're not necessarily using it to pay their mortgage. Okay, so what did we see? Other questions? Do you have any insights on the trend of converting variable mortgage to fixed rate mortgage? So I think the simple answer to that is we unfortunately don't see whether the mortgage is on a variable or fixed rate. We do know last year that there was definitely an increase in terms of new mortgages that were being originated as variable rates, likely because prices were high and interest rates were very low. But we're not sure about the conversion side yet. That's not something that we can unfortunately see. Swanima, there was a question around HELOC delinquency and why we think that potentially that is still coming down. Any thoughts on that one?
So recent HELOC balances, like the new originations for HELOC and a lot of consumers moving their HELOC during the lower interest rate periods. So we have seen a big increase in HELOC, overall new HELOC balances, which adds on to the portfolio balance as well. So for it's same as mortgages, like the mortgage average loan amount is really high, the mortgage balances are high, so we're not seeing that those delinquencies in mortgages. It's the same is applicable to HELOC products as well, because it's directly related to the price, the equity that you hold in your house. So that's why we've seen a huge growth in overall HELOC balance, and it is yet to translate into actual delinquencies.
Okay. So a couple of questions linked to why auto loan could be one of the leading indicators of consumer stress. There was another one that said, we've heard previously credit cards, missing payments tends to be one of the first ones to go. Why are we seeing that shift? So I don't know, Swan, if you want to maybe take that one and then I can give my thoughts as well on that one.
It's not, yeah, sure. It's not really a shift. It's either credit card or auto loans that consumers first go delinquent on. It could be either products or just credit cards. And it also depends on what consumers have, what kind of products. If you just have a credit card and a telco, your credit card will go delinquent first rather than going delinquent on the telco. And both auto and credit, and for consumers who have both auto and credit cards, we might see them going delinquent on both the products, especially if they also have a mortgage. And people would rather pay off their mortgage than credit card and auto.
Yeah, and I think the other thing I'd add to that, and we have seen it previously in some periods where we've gone into recession and things where, credit card is one of the first ones to go normally, and we do track things like the payment behavior on credit cards quite a lot, because when you start to see someone getting financially stressed, they'll start reducing their payments. I think one of the main reasons we might be seeing auto be a little bit higher, I think, first of all, that actually was really on the rise before COVID hit, and it was kind of maintained, I guess, or benefited a little bit because of those government programs and some of the lender deferral programs. So I think some of it will just be catch up from what we had before. I think there's also a piece of the credit card is clearly very important to consumers right now. If you really are struggling to make payments across the board and you need to go buy groceries and, you need your credit card to do that, which I think is happening for pockets of the population, then actually, if you had to choose between your credit card or your auto loan, well, right now, maybe I'll choose my credit card and let my auto loan slip a little bit. So I think there may be a little bit slight changes behavior we're seeing because of the situation we're in on the economy side as well. So I know we do have an awful lot of questions coming through, which is absolutely amazing. I do want to hand over to Kathy. She's going to be talking to you about what to think about, and then we'll come back to some more questions at the end if we have time. So Kathy?
Thanks, Becky. So I'm going to start off by talking a little bit about the mortgage market, since that was the last focus area that Swarnima walked us through. So what we've heard so far is that it's pretty clear that the housing market has slowed down with the rising interest rates this year, and that first-time home buyers are really finding it a lot harder to enter the market. This is a great segue to look at these additional mortgage-related insights, which have occurred in the last 2 years, where the rate of consumers with multiple mortgages has actually grown, and then talk a little bit about what this means to lenders in this space. So if we take a glance at the chart on the left, we see a comparison of two cohorts of consumers: those that have one mortgage, that's the gray bars, and those with multiple mortgages, those are the red bars. The bars represent the percent change from Q2 2019 compared to Q2 of this year. So in looking at this, it's pretty clear that across all provinces, the growth rate of the cohort with multiple mortgages is outpacing the growth rate of single mortgage holders. If we look over to the right now, while the actual size of the cohort with multiple mortgages is not that big in proportion to the actual mortgage market, what's interesting is that the debt levels for those with multiple mortgages has also increased significantly when compared to the same period in 2019. So what does this mean, and what should you be looking at as a mortgage lender? Well, for starters, I'm going to just take a step back. Let's rewind back to when the pandemic hit. The economic uncertainty and the halting of many industries led to an economic downturn, which prompted dropping the interest rates close to rock bottom to support the weathering economic storm. This actually led to what I would call affordable, actually motivated many buyers to invest in more than one property, despite a hot housing market, bidding wars, and higher inflated home prices. So as a result, we've got a pocket of multiple mortgage holders that are carrying much more debt and higher average monthly mortgage payments than we did back in 2019. So what does this mean? Well, a housing market that is cooled off because of these increased interest rates is really brewing some concern around the value of these investment property purchases actually dropping. So this is creating clearly some vulnerability for these consumers with multiple mortgages who have perhaps variable mortgage rates or a renewal coming up. So for mortgage lenders listening today, you may want to pay closer attention to the specific pocket of consumers with multiple mortgages who may be headed towards this path of financial stress. If property values tied to these mortgages actually drop significantly, these consumers will definitely be vulnerable. Again, looking out for early warning signs of financial stress, like relying on credit to get by, such as demand for increased credit limits, new credit products, higher utilization rates, and payment rates actually decreasing. So I'm going to just switch gears a little bit right now, and this came up as one of the questions. So we're going to look at a trend happening, which is around interest rate hikes and what this means for variable rate products and consumer debt. So we've got two charts here. On the left, we see a time series of lending funds related to new mortgages, which are depicted by the dark blue line and the red blue line. And in the background, that gray shaded area is actually the interest rate trend. So how to read this? Completely to the left, back in 2017, for example, we see that there's about $20 billion in funds related to new fixed rate mortgages versus about $4 billion related to new variable rate mortgages. And the interest rate at that time is about 2.75%. Fast forward now to sort of the middle part of this chart. This is the time during the pandemic. We see that as the interest rates started to drop, we saw a steady increase of new variable rate mortgages, followed by this surge in 2021, and conversely, at the same time, a decline in that fixed rate mortgages. So now, at the end of Q2, the share of new variable rate mortgages and new fixed rate mortgages are pretty much even. And that's depicted by sort of that conversion point right at the end. It's about split now, it's about 50-50. So what this is telling us is really that we've got many more consumers that are choosing mortgages with variable rates. So that's great. That's what's happening with mortgages. But what's actually happening with non-mortgage products and these variable rates? Well, we shift over to the right and we can see we've got another time series here that looks at the 2 windows of interest rate changes and compares the consumers with variable rate products like HELOCs and those without. So what we see here specifically is the last time we had interest rate increases in 2017, those that had HELOCs were actually more impacted because we saw more of we saw more credit card transactors from this pocket in this cohort become credit card revolvers. So to really simplify that is really we had fewer people paying off their credit card in full each month. So again, what does this mean and what should you be thinking about as a lender? So again, I'm going to just quickly recap because I like to do this. What we've really seen is, in the last little while, faster paced Bank of Canada interest rate hikes this year to really curb inflation. Yesterday being the latest one. And we've got some speculation that this is going to continue to happen until we hit a rate of about 5 to 6% before we see any significant impact to the economy. So the risk here is, just as we just talked about, we have many, many more consumers with variable rate products than we did back in 2018 when interest rates last steadily rose. So more variable rate products means more possible risk for that consumer at experiencing that financial stress that we've been talking about for the last hour and possibly defaulting and or leading to filing for a proposal or even a bankruptcy. So as a lender, it's going to be very important to continue your account management activities, really understand your customers in terms of what variable products they have with you and possibly with others. Understand your customer's financial position and the risk level they fall under. It's going to allow you to closely monitor and work with your customer to ensure they do not face financial difficulty, or you work with them to mitigate it. This is where customer experience is really going to play a pivotal role in the relationship you have with your customer and really helping to promote your brand in the marketplace. Additionally, it's also going to be very, very important to look at your acquisition strategies and policies to ensure you're lending to consumers that do have the capacity to take on more credit and how much, and really minimal risk at experiencing financial stress. Last thing I'm going to touch on, because I do want to leave some time at the end for some more questions, is earlier in the call, we heard Becky talk to us about delinquency rates, which we can say is a pivotal point in financial stress coming through. We heard that delinquency rates may not appear to be rising quickly, but actually, as she stated, and we will sort of double click on this again, if we look deeper, there's actually more missed payments happening at the account level, but it's being masked because of the increased balances, hence making the rate not appear to be that significant. So again, another way to sort of illustrate this point, we've got 2 charts here. On the left, we've got a chart showing the number of consumers with at least one missed payment on a non-mortgage product over the past few years. And it's split out by province to give you that provincial breakdown as well. So red bars being 22, and then the dark blue bars being 19. So while it appears that the red bar charts are not as high as what we saw in 2019, they are higher than what we saw last year. So again, indication that more consumers are in fact missing payments this year. If we move to the right, we see that the number of delinquent trades are actually increasing over the last few quarters. Those are the gray bars on the chart, while the orange line, being the average balance, is rising. And the red line being the average delinquent balance is actually falling. So again, packaging up all this information, what exactly does this mean and what should you be thinking about as a lender? So for starters, we've got more consumers missing payments compared to last year, which is signaling early signs of that financial stress coming through. Again, we've talked about this and a couple of questions were asked. From historical data, we know that when a consumer experiences financial stress, credit cards and fixed loan payments like an auto loan are usually the first to go delinquent, while mortgage payments and telco are last products to go delinquent. So as a lender, in addition to making sure, again, your account management strategies are identifying customers who are showing early signs of financial stress, like payment amounts for cards starting to decrease, new credit is being added, an increase in credit limits, utilization rates. It might also be the right time to revisit and evaluate your collection strategies and policies, as well as to look at your operational capacity to scale up if, in fact, more consumers start to miss payments and become delinquent. You need to ask yourself and your teams, will the collection teams be able to handle more cases if required? Last thing I'm just going to touch on and to close off is that with inflation currently at the epicenter of why we continue to have these interest rate hikes, this is what's really driving consumer debt levels increasing, the early signs of payment behavior changes that we've talked about. All of this is really pointing to signs of a potential mild recession in early 2023. So on that grim note, I'm going to pass it back over to Becky to see if we've got any questions from our audience. Thank you.
Thank you so much, Kathy. Always good to leave me with the big R word right at the very end there. So I think the one good thing when we think about the potential risk of a recession, and I do agree with Kathy, I think there is a risk there, again, is that actually when we look at things like the labour market, we're in a pretty strong position. So if we do go into a recession, it may not be as severe potentially as some of the ones that we've seen before, at least in terms of the job market side. Okay, so we definitely have a lot of questions coming through. I'll try and get through as many of these as we can. So we had one question on credit cards. What is the primary driver of increase in limits on new credit cards? Is it a product shift to more premium cards or high limits on existing products? So I don't know, Swanima, if you've got any insights you want to share on that one.
So credit cards, we saw the biggest drop. We saw the biggest drop in credit card. The growth really slowed throughout the pandemic, and it has taken more than 1 year for credit cards to revive to what it was pre-pandemic. And this has created a lot of consumer demand. And I'm sure there's a lot of lenders are being competitive, and that's why the credit limit on new cards is increasing. It's closer to what we have seen sometime back in 2015 or 2014, but it's not unseen. It's something that we have not seen in 2019 or 2018, because that's when the delinquencies were rising and we didn't see the same increase in credit limits. But now that the delinquencies are still low and there is a big consumer demand for credit cards, especially now the borders are open, we have new to Canada, new to credit consumers joining the credit market again. So that has increased a lot of demand for credit cards, and hence we are seeing the rising levels in credit limit assigned to new cards.
Yeah, thank you. And it is a big jump, I think, on those new credit cards limits is up $1,200 compared to this time last year. Swanima, I think that was the number, right? It's gone from 4,600 to around 5,800. So definitely a big jump there. Increased rates on variable rate mortgages. Obviously, that can cause an increase in amortization terms. Will clients need to increase their payments? And do we expect higher delinquencies coming in Q1 and Q2 2023? So I guess maybe I can start, and Swanima, maybe you can add to this. I mean, absolutely. I think eventually, if interest rates keep going up at some point, those variable rate mortgages, if you are on a mortgage where the monthly payment stays the same and it's more just the interest level that's changing, eventually you probably would want to be increasing your payments. Otherwise, that term can extend out quite a significant period. So I think there will reach a point where that needs to happen. But obviously, that really is linked to the lender piece. In terms of delinquencies, I mean, the challenge on mortgages is they do tend to be the last ones to go. And when we look back again through those periods where we've seen high interest rate rises historically, they don't necessarily get impacted until right at the end, if at all. So we definitely see the non-mortgage debt delinquency increasing first. I think, as I mentioned earlier, I absolutely expect those levels to keep increasing. The early delinquency, so what, looking at 30 days right now, that is on the rise quite quickly on both balance and volume. So at least for Q3, I don't see any reason why those delinquency levels will drop. I expect them to rise again. Going through into Q1 and Q2, I think it's really going to come down to how effective some of the economic drivers adjust. So, if these increases in interest rates do have a meaningful impact on inflation, and that inflation comes down, then I think that could give some relief to consumers. And I think, you might see that, yes, there might be some delinquency in there, but actually it doesn't end up being too bad in terms of rises. So I think it definitely depends what happens. I mean, the less good news, if you've seen some of the reports coming out this week, as we're looking towards the winter, is that those energy prices here in Canada are expected to rise quite significantly. Again, not in terms of some of the other global regions like the UK, where we're talking a 500% increase. In Canada, they're talking about the areas around 30% increase. But again, if you have consumers who are on the margin, who are already feeling that, they're only just managing their payments, an additional 30% on their energy bills potentially could push them over the edge. And, Canada's not the sort of country where you can necessarily manage without heating in winter. So, I think that's going to be a bit of a challenge still to come. Okay, in terms of leading indicators of a rise in delinquency, do you see if people tend to apply for more credit cards, or do they increase the balance on the credit cards they carry from month to month? I don't know, Swanam, if you have any insights on that?
So I think both is true. We have seen that during financially stressed times, consumers tend to try to get more credit. So you might see a growth in the number of new credit cards that a consumer takes. And also you will see a greater increase in their credit card utilization. Like right now, utilization is around 22%. But as consumers get more financially stressed, they keep increasing their credit card balances. And they also start getting new credit to avoid going delinquent on the existing cards, because that's the only time that they can get new credit, because they're no longer getting delinquent.
Yeah, absolutely. And Swanam, have you seen any big changes yet in terms of the credit score distribution? Is there any big shifts that we're seeing? Are we seeing more consumers, lower score, things like that?
So we did see a big spike in consumers' credit scores going up during the peak pandemic period, when there were a lot of deferral programs and government benefits that helped consumers pay off their debts. So we saw an increase in credit scores. But now it's not dropping, but that it is stabilizing. We are not seeing the same increase in credit score that we saw in July 2021 or June 2021. It has slightly come down, and it is just stabilizing now. And I think we'll see a bigger drop in scores as we see a bigger increase in delinquencies.
Okay. And just staying on delinquency, the rise in credit card delinquencies, is that coming from any particular segment, Swanama? Is it maybe younger, older? Are we seeing it kind of the high risk, low risk areas? Is there anything in particular, any regions that we're seeing that come through, or is it across the board?
So younger consumers, definitely you're seeing a rise in their balance delinquencies. But overall, if you're looking at account level delinquencies, more consumers are missing payments. So you can see that increase across all age groups. But the balance delinquencies is rising for younger consumers since they have lower overall balance. So that's why we are able to see that rise in delinquencies much earlier than the older segments. But looking across the board, we are seeing that the account level delinquencies are increasing.
Okay, and I know we focus mainly in this particular webinar on products like credit cards and loans and things. What about telco? Have you had a chance to look at any of the telco delinquency levels yet? Do we know what they're doing at the moment?
I think the trend is very similar for telco as well. We are seeing telco delinquencies are also rising from the bottoms that we saw in peak pandemic period. It's just telco delinquencies, it also takes time for telco delinquencies to come through, just like mortgages. Consumers tend to pay off their telco debt as well, because though mortgage is a higher payment, that's why people don't want to miss payments on mortgages. But telco is a very important part of your life. You need your phone to do anything, from banking to even ordering stuff. So you need telco for a lot of things, and hence we'll see that the telco delinquencies will also come through in the later part of the year once we start seeing a bigger increase in cards and auto loans delinquencies.
Yeah, absolutely. I know we've definitely seen that before, where it's higher up the payment hierarchy on the telco side. Okay, just one last question, just on the credit card side, in terms of revolver transactor behaviour. So consumers that maybe have a balance and it's they don't pay in full versus those that pay in full. Are we seeing any big shifts in that right now?
We're seeing a rise in percentage of revolvers, so consumers not paying their balances in full. There has been a very huge drop that we've seen since 2020, and now it's starting to rise. And as we have seen in 2017 and 2018, with interest rates increasing, we saw a big jump in revolving behavior, and we might see the similar jump now that the interest rate has increased by 300 bits at such a short amount of time. The only reason we are not seeing that yet, because consumers do have some disposable income from the peak COVID periods that's still helping them with their payments.
Okay. So there's a question around buy now, pay later. So as those companies don't always report to the Bureau, are we missing part of the picture, given the take-up rates in the last few quarters and kind of some of the impact on that? So you're absolutely correct in that missing some of the understanding of what a consumer's full picture, their full debt might look like, can be a bit of a challenge. And I know we are hoping, we're working with some of these organisations to see, can they start reporting to us so we can close some of that gap. I think kind of back to what I was saying at the beginning, when you look at Australia, they definitely are seeing that. They're seeing some pockets of consumers starting to stack these types of loans. So, when you kind of go and you put something on, I'm going to pay it over 4 payments of $25 each. I mean, that's fine until you have 10 of them. And all of a sudden you can find yourself getting into difficult waters quite quickly. And we're seeing that in some of the other regions globally as well, where, buy now, pay later has been used for groceries, I think, too, in the UK, for example. So definitely seeing consumers starting to leverage those types of solutions, and they're good. Don't get me wrong. I think they're a valuable part of the credit ecosystem. But again, not being able to see that can be a bit of a challenge. And I think also it's very easy for consumers to get into a behaviour of stacking those loans, which potentially could put them in some financial difficulty as well. So I know we've only got a couple of minutes left, and we have had an awful lot of questions come through today, which I take as a good thing, because I think that means that we've hit on some important topics. There were several questions talking around what we're seeing for very newly originated debt. So, if someone's just opened a credit card and spending on it straight away, are we seeing higher delinquencies on those new vintages than perhaps we've seen historically, and kind of some of the impact that might have, and how consumers are using one type of debt potentially to pay off for another. So we don't have time to go through all that right now, but what we will do in our Q3 webinar, we'll make sure that we have a vintage section in there so we can start to look at how some of that is changing over time, because I absolutely expect to see that there will be some of the consumers that have high demand right now, definitely may be the ones that potentially are feeling a bit more stressed, and you might see some higher delinquency. So we'll go through that in our next session. A couple of things before we do end today. Please, there is a survey that you can click and you can give us some feedback. We really value your thoughts on these webinars and all of the elements that we do, and we do take it on board, and we do try to do things differently next time if the things that don't work very well, or at the same time if the things that do work well. So please fill in the survey. We also do have our small business credit trends discussion happening next week on the 15th at 1 p.m. Again, commercial lending is heavily linked to consumer, because obviously employment and things are linked there. So highly recommend attending that webinar if you haven't registered for that so far. And apart from that, thank you so much for listening to us today. I know there's a lot of things going on right now in the consumer market, and I'm sure we're going to see even more movement for the Q3. So please look out for the invite, because I'm sure we're going to have some interesting things to talk about. Thank you, everybody, and we'll see you next time.